What the hell's going on, guys? Today I want to talk to you guys about uh, essentially an example of where one of my friends went to their financial advisor and came back and immediately called me up and said, "Hey, we want to go line item by line item and double check these fees to see if this is actually something that's worthwhile." So this is kind of utilizing their example here in graphic form as to what type of potential they could essentially be missing out on. They started off with about $25,000 with this financial advisor, and essentially this is just me utilizing their specific inputs and kind of putting in some other assumptions, like they might be putting in another $5,000 a year, and really looking at what type of fees they're missing out on. Not only the fees, which are highlighted in the red here, but also the total return that they lost due to those fees not being able to accumulate returns because they're now going to the money manager. Um, Now, I should say, money managers in total obviously need to get paid. They're obviously there to give you a service, but at the same time, you need to recognize that what they have you involved in, sort of mutual funds or what have you, are also not pulling away from what type of returns you could be getting. So a 1% advisement fee actually isn't too bad. I mean, I hear a lot of people say that they get charged anywhere between 1 to 2%, with anything being above 2% really being really bad. 1.5% is also not too horrible as well. But this person's also charging a flat $700 a year, which for a $25,000 portfolio is pretty extreme, right? I mean, in order to get this to be 1%, you need to essentially have $70,000. So just for the advisement fee for this money manager or financial advisor, you need to have at least $70,000 into the account just to make it a 2% return. Now, of course, if you were to say have $7 million, you'd basically be only having a 1% advisement fee, which gets you to the point where this is actually pretty good. So I guess it really depends on, for this type of person, what type of funds they have invested. So since I know my friend only has $25,000 invested, this ends up being 3% or actually almost close to 4% of total fees that are going to this financial advisor just because of the ratio of money that they have versus this flat fee. So that's something to keep in mind. And then also went line item by line item with my friend to double check, what type of mutual funds they were invested in, and obviously what type of expense ratios they had. So I know one in particular had a 0.55% expense ratio, and I think they were getting charged a couple $100s for that. And then the big one that they had was, I want to say they had like $9,500 in this 0.84% mutual fund. Mutual fund has done really well over the past couple of years, but at the same time, I'm sure there's other Vanguard or iShares or other lower expense ratio funds that have done just as well that are getting you the same exact thing. So that's something to keep in mind is, yes, just because it's a mutual fund, one, how is it doing against the S&P 500 over the past couple of years? And then two, why does this money manager potentially have you in this fund? Is it really that good of a fund? Because obviously, if it's making 15% returns and the S&P 500 is only returning 8%, yeah, pay that 0.84%. I mean, that fund is killing it. But at the same time, if this thing's not even matching the S&P 500, or it's up 1% or down 1%, on the S&P 500, it's really just tracking it, and you're paying this 0.84%, you could easily just put your money into an S&P 500 fund and pay 0.07% with Vanguard or iShares or what have you. So at the end of the day, this is the specific portfolio, and then we'll kind of get over to the graphic and fool around a little bit. But this is essentially what we calculated. So it's a $25,000 initial investment, $250 immediately to the financial advisor for the 1% fee. $700 immediately for the financial advisor flat fee, and then the 3 or 4 mutual funds that I saw was about $190 a year, which is just under 0.8%. And mutual fund expense ratios, um, that in its own, I was just like, Jesus, we got to get you out of there. 0.8%, that's a lot. I mean, generally speaking, I try not to, even if it's a really good fund, I try not to go over 0.5%. So, I mean, there's so many funds out there that are, when Vanguard and Fidelity and iShares are really changing the game with respect to their ETFs. It's like, it's very rare where I would want to put anything above, a 0.35, 0.5% expense ratio. And then there was a couple, Vanguard iShare expense ratios that they had in there that were, 0.006, 0.007, 0.1, and I was just like, yeah, those are fine. I know exactly what that financial advisor is going after there, but just thinking about it in that perspective, they were getting charged 4.6% of this 25,000. Now, if they don't ever put another dime in, every single year they're going to be getting charged, say, another 4.6%. If this portfolio grows to, let's say, $100,000, they're still going to be getting charged around 2.5% because this flat $700 isn't going to be as extreme as it was. But at the end of the day, it's still a lot of money to be paying in financial advisor in terms of that. So going back to the actual, type of graphic. So you're starting with $25,000. Say you put in another $5,000 a year, you get an 8% return, which is phenomenal. 1% advisement fee, the $700 flat fee, and then the 0.8% expense ratios with all the different mutual funds that they have. So over 25 years, they would essentially be paying out, $89,000 in cumulative fees. The total difference between the two portfolios would be $200,000. So with a portfolio that you would expect 8% return, paying the fees, you'd expect to return and get about $380,000 over the course of 25 years. Not horrible, not horrible. But if you look at it in this perspective, without any fees, if you're to say have done this on your own, or just been really lucky and get an 8% return and stock picking, by yourself, picking individual stocks, you'd be walking away with $580,000, which is a loss, say, just from fees of $200,000. I mean, that's huge. That's extravagant. Now, what's really the game changer? Now, the $700, early on is huge, but once you get later into the game, I mean, you could actually look. The fees will be, less than the $700 will be, just over 10% of the total fees that are being charged in year 25. So if you think about it, $700 really isn't too big of a deal. You would go from, let's say, 89,000 down to 78,000. It's not too huge. The real thing is, at the end of the day, are these expense ratios. I doubt that you're going to get a financial advisor that gives you less than 1%. I think that's going to be very hard unless you, say, have a huge, massive portfolio and you have it managed by, one of the big, huge, high wealth advisors or something like that. But one thing that you can attack is this expense ratio. Now, obviously, you're probably not going to have everything go down to zero expense ratio, but if you did, you'd essentially, and getting rid of the flat fee, you'd essentially knock in half almost your entire expense ratios throughout all the time. And you would essentially capture that half of that portfolio variance, but you would still lose out just from this 1% change, $100,000, right? I mean, that's pretty substantial if you think about it that way. But you're obviously not going to get that. But let's just say you get it down to, say, 0.01%, right? You're still lucky enough. So this would be like investing in your Vanguards, your really low Charles Schwab's, your iShares, stuff that is basically, they're basically just doing passive, utilizing index, funds to match everything. Basically just having it set on autopilot and just matching what the funds are essentially tracking, and say like the S&P 500 or the Russell 2000 or what have you. You're essentially getting half your money back, which is huge, right? Which is massive. But at the end of the day, one thing I want to show you guys is how this fee really changes over time. So like I mentioned before, the fee essentially is this purple here. It goes from about 4.5%, 4.6% initially, and then by year 25 it starts tracking down to 2%. Asymptotically, I think it'll end up going to about 1.85% with that $700 being that extra 0.005%. But at the end of the day, 2% isn't horrible, but at the same time, you're paying. It takes you 25 years to get this 2%. I mean, throughout time, you were essentially paying above that 2% this entire time. I mean, and this really is the graphic that you want to see. I mean, after 25 years, and this is only putting $5,000 additionally every year. If you were to say put in $10,000 or another $25,000, this is going to be massive. In fact, let's just look at it, right? So let's just put in, let's just say another $25,000 for the year. You're essentially missing out on $600,000, and your fees are going to be, almost half of that. I mean, just look at that. It's pretty huge. I mean, just look at it. Your potential lost return is over almost $600,000, and your total fees are almost $300,000. I mean, that's huge. This gap between this light blue and this gray is just, I mean, that's people could retire off of that. I mean, $600,000 to a lot of people. Some people won't even make $600,000 in their lifetime. So to be thinking that you're just pulling money out and stealing the money there to be able to pay for this financial advisor, I 100% agree. Financial advisors to some people are absolutely necessary, for peace of mind, and they don't want to deal with it, and they don't have the time. They'd rather just make their money, and they're phenomenal at what they do, but they don't want to do personal finance. I understand that. I get that. But at the end of the day, you need to watch your money managers and double check that they're not just putting money in a fund because they can. They're putting money in a fund because it's the best thing for you, right? That it meets your allocation needs, it meets your diversity needs, your diversification needs, it meets your expense ratios. I mean, my friend and I went through, and we double checked, some of these other funds, and some of the funds that they had him or her invested in, and I was like, this 0.85%. I was just like, this expense ratio could be lowered by 0.8%. You could invest in something that gets a 0.05 or 0.1% total expense ratio and get the same return, right? Like, I understood, in the fund that they had this person invested in at 0.85% was actually pretty good, but the other two, the other one was like 0.7 and the other one was like 0.65. I was like, these two, you could easily switch to a Vanguard or iShares or Charles Schwab and eliminate, half of that. I mean, just getting rid of, say, 0.1%, 0.1% can easily get you another $180,000 if you're just looking at, from 0.8% to 0.07%. I mean, it's 30 grand. You literally save $30,000 throughout your lifetime. I mean, you're easily another $1,000 a year in total income. I mean, that's something you guys just need to watch out for. And I'm not saying don't use money managers, but at the same time, beware of what they're putting your money into and double check the expense ratios that they have you and ask. Just remember, just be like, okay, why are you putting me in this fund? How does it associate with diversifying my portfolio, and how does it get me the returns that I need, and how is it different than, say, something with a lot less expensive expense ratio? So I know it's kind of a rant, and I apologize if it seems like I'm being very pushy and hesitant towards using financial advisors. I'm not. I respect that financial advisors to a lot of people are necessary. I personally do not use one. But at the end of the day, what I hate seeing is financial advisors putting people into funds that have high expense ratios and also charging them, upwards of 2% to manage their money. So, really hope you guys enjoyed this, and I really hope that it gives you guys some help in your financial investing career. Feel free to like, subscribe, and leave comments down below, and I'll answer them as soon as possible. And I look forward to talking to you guys soon. Feel free to give any suggestions as to what you guys want to see, in the comment section down below, and I'll try my best to open one up and give you guys the videos that you want. All right, have a great weekend. I'll talk to you guys soon.